What you're telling me is that music is about to stop, and we're going to be left holding the biggest bag of odorous excrement ever assembled in the history of capitalism. 1974, 1987, 92, 97, 2000, and whatever we want to call this. It's all just the same thing over and over. We can't help ourselves.
I say when we sell. Hey, I say when we sell.
Hey everyone, welcome back to The Last Trade. Jackson, our noble and fearless leader, is out for this week. So I'm stepping in, Brian Cubellis, Chief Strategy Officer at OnRamp. And I'm joined by Michael Tanguma, as always, and also joined by Liam Nelson, partner at Early Riders, and Cam Stromey, who leads private wealth at OnRamp. And we had a really great discussion. We dug into the debasement trade that's finally gone mainstream. Gold is ripping. Bitcoin just printed new all-time highs. And the largest players across markets are really beginning to say the quiet part out loud in terms of dollar debasement and the unsustainable nature of our debt in this country. And really, that flows to all fiat currencies around the world. We'll also react to fresh signals from Ken Griffin, Paul Tudor Jones, Ray Dalio, who are speaking about this trade. We'll also unpack why it's not really a trade, or in other words, it might be the last trade. We'll also unpack nominal versus real returns and look at what happens when you change the denominator to sound assets like gold and Bitcoin. We'll also discuss the ETF surge, why ETFs are a helpful access point for folks, but not really an end state in terms of Bitcoin ownership. And we'll lay out some practical paths to resilient ownership, and then also zoom out to the sovereign level, Japan's financial repression, India's CBDC push alongside gold stacking, Germany's pension stress, and why stablecoin giants like Tether are starting to look like mini nation states. And so if you're just trying to navigate the shift from inside money to outside money, this one's for you. Quick note here, nothing is investment advice. With that, let's get into the show. All righty, gentlemen, we are back. Slightly different crew today. Jackson, our noble and fearless host of The Last Trade, had a little family emergency, the good kind, I should say, and we'll let him elaborate on that when he's back. But needless to say, I'm the host today. I'm your captain. I'm joined by Michael Tanguma. I'm joined by Liam Nelson, and I'm joined by Cam Stromey as well, head of private wealth at OnRamp. And lots of topics to get into today. No shortage of news, no shortage of commentary on the debasement trade, folks. Something that folks on this show have been talking about for some time now, but seems to be permeating into the zeitgeist a bit. Both gold and Bitcoin are running. Gold's at 4K. Bitcoin hit new all-time highs over the weekend. Was around 125 this morning. We've crashed back down to 121 right now. But boys, how are we doing? Thanks for joining today.
Doing good. Excited to have Cam join, and Liam. We talk with him weekly on Final Settlement. Cam leads our private wealth team. You guys listening probably know, have worked with him, have been onboarded. The show's called The Last Trade for a reason, everyone. And it's been understood on a long enough time horizon, Bitcoin is the last trade. But until then, gold will play a big and heavy part of the financial system. And the market's starting to wake up to it. And it's going to be a very interesting ride. We have some clips to play. But before we do that, guys, anything to share? Cam, how are you doing?
Doing well, and I've been eating some crow from my gold friends in Texas, and Michael, you're one of them, so I'm going to suck up to my boss a little bit here on air, for calling out gold years ago, but I switched from, on my phone, looking at BitBo, just that indicator, to now looking at TradingView, because I can see Bitcoin, gold futures, and then the Bitcoin pricing gold chart, and that's giving me a better picture of kind of where we're at relative to this debasement trade in recent months, but that is astonishing to see an asset, literally a shiny rock with such a large market cap relative to Bitcoin, go parabolic. And then also so bullish for Bitcoin, because this is not in isolation anymore, where Bitcoin is having a retail rally. Is just part of a broader narrative that many of us have been, calling out for years, but now we have kind of the backing of so many different voices that are pointing out the same issues. So all that to say, I was telling my wife about this in the kitchen the other night. It's not just Bitcoin, it's about gold too. And there's this whole broader narrative, which is really exciting to think that the world is going back to sound money.
Just like we had a breaking. Your local podcast influencer may not know everything about the world because gold was on no one's radar. Everyone has these total addressable market clips where it's just like everything stays static. We just have to hit, back in the day, it was 350K to hit parity with gold. Gold added $11 trillion to its market cap in 1 year. Now it takes like 1.2 million, and that will continue to run. And breaking, your local Bitcoin influencer might also not know about Bitcoin treasury companies, but we'll save that for later in the podcast. But folks listening, it's great to learn. It's great to follow the podcast, even this one. Take them with a grain of salt. Do your own research. The same thing goes for holding your own keys. Yes, it's valuable, but we're not going to go into a world where everyone's holding their own keys. Friendly disclaimer. A lot of people have no idea what's going on here.
It's well said. You referenced we had a few clips to play, so I'm just going to go into the first one. This is Ken Griffin. I guess this was at some sort of conference yesterday, but let me know if you guys can or can't hear this when I hit play.
And substantially above target in all forecasts for next year. I mean, it's part of the reason the dollar's depreciated by about 10% in the first half of this year. It's the single biggest decline in the US dollar in 6 months in 50 years. Gold is at record highs. And the appreciation in other dollar substitutes, to use that word loosely, in items like crypto, for example, is unbelievable. So we're seeing substantial asset inflation away from the dollar as people are looking for ways to effectively de-dollarize or de-risk their portfolios vis-a-vis U.S. sovereign risk.
Are you really seeing that?
No, just check the price of gold.
Well,
I mean, I don't have to look very hard.
It's a life of its own. Yeah.
What?
It's a life of its own, gold.
No, but it's a life of its own as you see sovereigns around the world, as you see central banks around the world, as you see individual investors around the world go, you know what? I now view gold as a safe harbor asset in a way that the dollar used to be viewed. That's what's really concerning to me. And there's been plenty of published research in recent weeks, months, about foreign investors now, when they buy U.S. equities, hedging the returns back to their local currency. So that, again, is a bifurcation of I'm going to bet on American business, but I want to immunize some of my sovereign exposure to the United States.
Okay, so that's the clip. And, maybe I'll kick it, Michael, to you first. Initial thoughts on this. I have some of my own, but I'll kick it to you first.
Yeah, I mean, I think that the biggest one, just looking at that chart of $4,000 gold, is just absolutely insane, because it's not gold getting more valuable, it's the dollar becoming worth less. And the notion that you have Ken Griffin, you have some of the largest hedge fund managers. We're going to pull up another clip in a bit. It really should scare everyone, because it's the notion that this is becoming not only understood, because I think it's been understood by a lot of people for a long time, but it's becoming part of the natural lexicon and discussion that the dollar is basically cooked. And the thing is, and this is where I was referencing the last trade, is all of these concepts were taboo. And that's where you saw this cyclicality with Bitcoin as a risk on, and then individuals that understood this were long-term holding. But the reality is, where do we go from here when the largest institutions and sovereigns are effectively telling you that the dollar's done? And they're saying this by getting out of treasuries. They're saying this by different actions, and they're doing. And so it's a very astonishing thing to see, because gold hasn't really been allowed to run like this for a reason. And it's making its move, because you can't put the genie back in the bottle. And it's going to be a very interesting ride for the next 10 years.
Yeah, the notion of this only being a trade is there's sort of a logical inconsistency there, in the sense that if you handicap or break down what is causing this trade to exist, it's the 37 trillion in debt, it's the deficit spending, it's the sort of unsustainability of the fiat system, which isn't going to be solved likely ever, or at least not in the foreseeable future. So, to your point, Michael, where does this go? It's not a trade. This is a structural shift in how people perceive money and value, and inside money versus outside money. Go ahead, Liam.
Yeah, I was just going to say, I completely agree with that. But just like for the past 40 years, bonds were a trade. They were a great trade after the 1970s. And, they raised rates in the double digits. And then essentially, just because over the prior decades, it kept rates artificially low, and then they couldn't actually maintain the peg because with gold, because there were too much dollars in the system, and they actually had to increase the supply of dollars, and they had to break parity with gold. Then after they finally tamed inflation, or relatively tamed it for what the central bankers were looking for, they were able to, and they pretty much had to lower rates over any large period of time, and just, expand the world, globalize, in order to actually have the prices of TVs and all of your products and services go down over time. And so bonds were a great trade then. But we're seeing the reversal of that now, essentially with increased fear that the US dollar and pretty much all currencies are don't have a way out of this without extreme debasement. And so that's why we talk about gold a little bit too, is it's not just going to be one asset in the trade that makes the most sense. And I think the purest way to play the debasement trade is Bitcoin, but there are going to be a number of other assets like gold and products and services around those assets that end up creating and capturing a lot of value, just like how with the 40-year bull market and bonds, home prices captured a ton of value as well. So it's not, it is a trade, but it's probably more like a 40-year trade.
There's two aspects around that. One is just the notion of, the purest way. It's a great way to play it. The reality is, the world's not black or white. There's nuance, and whether it's portfolio construction or really time horizon / volatility profile, and currency pairs, right? I think for a while I've been thinking about it's naturally going to be stablecoins, gold and BTC that are going to just be trading around, and also for oil, frankly, as the net settlement. And then we'll figure out the best product services that reduce counterparty risk. But going back to the clip, one of the most fascinating things of the clip is it's like in a microcosm of the example of a conversation you would have in any state of explaining sound money to an individual, because she's like, well, what do you mean? Like, do you really believe that? And she's like, well, have you seen what gold did? And she's like, that's just basically the inertia.
She has a natural inclination to just dismiss it as something that's like external to what they're talking about.
And to add context that we pulled up before we started recording a 2014 Financial Times clip, it's really funny when you just break it down. The headline was gold, a 6,000-year bubble, or I don't even know, it wasn't a bubble, it was a 6,000-year something, but equivalent of bubble. It's just like the reality is, this is honestly like the proxy for why the world's so messed up, because if you don't understand where values derive from, then everything else is just going to have like a shaky, structure on top of that unsound foundation.
Yeah, basically that there could be a 6,000-year anomaly where you have non-government created money that could still exist and have value and be growing in value. Then I think the other thing we're getting at is this strange notion in the Keynesian philosophy that if you actually call out inflation, that's actually the primary cause of inflation. It's not so much money printing or money creation or credit creation, but it's actually just acknowledging that there could be or is inflation, which then sends like a false notion, in quotes, to the population, which is creating this reflexive loop that actually then creates inflation. So it's I think part of what's shocking to see Ken Griffin and Paul Tudor Jones and others acknowledge this outright is that this is typically what they don't do, is like, this is the elephant in the room that you can't acknowledge. You can talk about why other assets are performing well, but not into relation to the root problem.
Yeah, no, that's a really good point, Cam, because like you can hear it in his voice in the second half of that clip that he's like, this is concerning to me. Like, this is, it's almost like the jig is up in a certain sense, and everyone is slowly starting to realize it, and then thus, position themselves, place their chips on the table. Should we go to the second clip we wanted to play?
Yeah, let's do it.
Okie dokie.
Look at the biggest winners, right? The biggest winners are gold. I think it's up 46, 47%. Bitcoin, I want to say it's up 50 or 60. I'm not even sure. There's a Morgan Stanley basket that's a retail flow basket that has all the meme stocks in it. It's up 67, 68%. So it's really what retail jumps on. So crypto, digital gold, that's obviously something that's very, very appealing.
Does that mean you're jumping on all of that right now?
Well, I'd want to have positions in all of it, for sure. So if you said to me, what are going to be the winners? Again, we have this race.
Right.
The race, realistically, is certainly to the end of the year, because that's when everyone marks institutionally. And then you have to figure out what's going to go on in next year. So what would I want to have? I'd want to have a combination of gold, crypto, probably the NASDAQ. I think, I want to say that I've said that before, and I think that's still the right one. And I think whatever the fastest horse is at this point in time probably has a good chance of being that on deck 31.
So you got to love, like, I think Paul Tudor Jones is worth roughly $8 billion, pioneered the modern hedge fund industry on Wall Street. By the way, like, slow walked and maybe played possum his way to 8 billion, because he sounds like just a good old boy you'd find in the, back streets. It reminds me of, give Cam a shout out for great flick, Hell or High Water. If you ever watched the movie, she's like, well, what aren't you having? He's right now saying, what aren't you having? Gold or Bitcoin? Like, what don't you want? There's a reason why they're saying this too. When you think about Paul Tudor Jones and Ken Griffin, like, the bags are packed, they're ready to go, the system's cooked, the dollar's cooked. But it goes back to the same point. Doesn't make it untrue as well.
Yeah, I mean, my takeaway from that, I mean, first of all, ton of respect for Paul Tudor Jones, but he is, he's still fundamentally a trader. Like, so he is thinking more short term than maybe us or I am about this quote unquote trade. He's sort of thinking through the end of the year and then reassessing. But towards the end, he sort of harkens back to a famous clip of his from probably 6 or 7 years ago, where he talks about Bitcoin being the fastest horse. And so he harkens back to that sort of mental model and says, sort of own whatever the fastest horse has been through the end of the year, which, I mean, right now, technically speaking, it would be gold, which is outperforming Bitcoin over this calendar year. But, if you go back to when he first said that, Bitcoin has been by far and away the fastest horse. So if you just stretch out what he's saying here and have a little bit more of a long time frame on it, it's very clear that he is, vouching for Bitcoin as the fastest horse. So that was kind of the takeaway for me.
Yeah, I also don't go ahead, Cam.
I was gonna say, when he came up with that fastest horse moniker, I thought it was fascinating because he and his team had put together a framework to evaluate Bitcoin, and it was similar to what VJ had done in Bullish Case for Bitcoin, where he made the chart of properties of gold, properties of Bitcoin, properties of the dollar, and then compared them, and he gave Bitcoin some sort of relative score, and he said, oh, this is really something worth owning. This actually gets quite high marks. So he was willing to dig through the Bitcoin's bad reputation, or I think it was pre-FTX or whatever the negative headlines could have been about the day, and just take a look at the objective asset properties that it has and say, yeah, this is going to do really well, given what else I know about the dollar and about the situation we're in.
Yeah, exactly. And it's just a recognition too that even if he is a trader, it's pretty much like he is looking at Bitcoin and gold, and Bitcoin in particular has always been a little bit more volatile too, is the best way to express that view of debasement in the short term. And so, he's been pretty consistent on how he is a big fan of Bitcoin over the past, almost decade or so. And so he'll be in and out of trades, etc. But just a recognition that it is something that is core to the portfolios, and a proxy that we pretty much talked about earlier this week for dollar debasement just makes it a great way to play the trade.
There's one other aspect that's worth calling out here, and it takes place in a couple of things. Like, there's a notion of, I think people just really forget, Bitcoin's core value prop for the next 10 years is literally just the store value. Like, if it does that, it achieves what it was meant to do. We don't have to worry. You have to be able to naturally be able to send and receive without censorship. But the reality is people are parking capital to store value, and that gets lost from the crypto people and it as a speculative asset, but it ties back to his underlying thesis. Because if you remember back in the day when he was doing that diligence that Cam was referring to, the thing that he references in a few areas publicly, that he couldn't understand how it could retrace 80%, and that the majority of holders were still holding this thing. And that ties back to certain monetary properties that make it objectively a better form of storing value and money. And as long as those retain intact, more and more people will, go into that. It's the money's the bubble that never pops, right? And so that's the core idea here, is like we sometimes lose sight of this notion of a trade. It's like fundamental to society is you need to be able to park your wealth in something that will persist into the future, so then you can coordinate economic activity. It's as simple as that. And everyone just seems to like make this a lot more complicated. And so anyway, I think that's just like an interesting part of, he may be trading his position for his personal account and also his portfolio, but I guarantee you he has a core position in this, because it's like, well, what else are you going to, Paul? Like you're moving out, swashing around $8 billion of financial system full of counterparty risk. Because again, this stuff doesn't happen in a vacuum. So if this amount of debt exists in the system, well, people aren't going to be made whole. How do you actually assess that risk? And that's another thing that gets discounted, is even if you can potentially make quote unquote more Bitcoin, you still have to play the exit game, the tax game, and then hoping to God that whatever you're in doesn't get rugged. That's why there's Zen in just storing your value and money and then going back about your life. But for some reason, the majority of the world isn't there yet.
Yeah, that's the that's the Zen of saving over speculating, sort of full stop. I did want to just pull up a tweet of my own here that to just round out the conversation on the debasement trade, because it's not just Ken Griffin, it's not just Paul Tudor Jones, who's been bullish on Bitcoin for a while, but it's the Morgan Stanleys of the world, the JP Morgans of the world, the Goldmans of the world are all sort of parroting the same lines right now, and it's also reflective of this. This is a chart from River showing global central bank reserves and the effective flight from fiat currencies, namely U.S. Treasury debt and dollars, towards Bitcoin and increasingly, or towards gold and increasingly Bitcoin. This is a similar chart, just in a different format, just showing gold overtaking U.S. Treasuries as the primary central bank reserve asset. And then this was a great tweet from Eric Balkunas last week, which showed a day last week where both GLD and IBIT were in the top 10 ETFs by volume, which is rare. And he references the debaser or the debasement trade here as well. So this is all happening in concert in real time. The biggest voices in macro, the largest institutions in TradFi and the fintech space more broadly, are opening their minds to the debasement trade, sound money in general, and moving from what was historically, a very small portfolio percentage, at most 2%, at most TradFi firms, to talking about 20 to 25% in gold. Like that is a material 10x jump in what that allocation looks like. And so, I just wanted to put that context around it, because it's all happening very fast in real time, and everyone's sort of parroting the same lines, which, effectively are the Bitcoin thesis. It's what Bitcoiners and gold people have been saying for a long time. You need to protect yourself from the debasement of fiat, generally speaking. And it's just permeating into the zeitgeist now. And I guess you could also credit a lot of what this administration has done in the sense of removing the toxicity from the asset, so that this change in thinking around what Bitcoin is and what it represents and where it fits in a portfolio could actually manifest and take shape in a real way. Like, I think you needed the ETFs for that to happen. You needed the air cover from this administration for people to start talking about Bitcoin and gold in this sleeve, where it's really pivoted in a very short amount of time from Bitcoin's, riskier NASDAQ exposure, high beta to the NASDAQ, to, no, it's actually more similar to gold, which would historically be risk off. And, as we know, in terms of its objective monetary properties, it's extremely risk off. It's the only transparent, finite monetary policy in human history. But that pivot is something that, I think Bitcoiners have felt for a long time should happen, but now it's actually happening in real time in a very short amount of time. We've moved from, I think, even at the beginning of the year, I think most of these firms, the Morgans, the Goldmans of the world, were still talking about it as super volatile, risky tech-like exposure. And this dynamic that we've seen emerge over the past month or so is completely the flip side on its head.
Yeah, one of the exciting things, maybe you can pull up that Luke Roman tweet, because it's funny. Bakun has called it the debaser trade. I haven't heard the debaser since like Terminator. The debaser trade. I think what's interesting is I think it's going to help accelerate the discussion we've been having around nominal versus real returns, because ultimately it's been obfuscated with the S&P going up and to the right, and as well as other assets. But as you start benchmarking them against gold and Bitcoin, and it's just math, right? If you have a number of monetary units being inserted into the system, well, you're naturally going to have assets go up. But then if you have scarcity component, like a money properties of gold and Bitcoin, those are going to move faster. They're going to be faster horses. It's just math. And I think this ties into some of the stuff we did at Early Riders and being Bitcoin denominated, because at the end of the day, it's easy to return dollars because they keep printing more of them. But in good faith, if you look at 10 years from now, like how could we talk to investors and say, oh, lock up your capital and we'll pay you in 10 years? Like, I'm not saying the dollar is going to go away. There's a non-zero chance in 10 years the dollar you might not even use to light on fire. Maybe you use it to light on fire, but not anything else valuable. Point being is that more and more capital allocators are going to start asking questions of like, why am I not just holding these two assets versus putting capital at risk? And it's going to mean there's going to be a lot less venture capital funding. It's a lot less financial products across the board. And that's like positive for everything. I think we're still a ways from that, but it helps when you have the largest institutions effectively explaining this debasement trade, because that's one step away from, well, if it's a debasement trade, like, is everything being debased? Like, is everything moving up because the dollars are worth less? Versus most people think their house is getting more valuable every year. And this is the world's healing, basically.
Yes. Like if you are beginning to come to the recognition of this, what is being called the debasement trade, the natural evolution of that is saying, okay, well that is a denominator problem, right? Like if I'm being debased, like the issue is with the denominator. So what we have up on the screen here is if you substitute that denominator for actual hard money, not dollars, and you instead price assets in gold or Bitcoin, the results are pretty stunning. So what Luke Groman is showing in this chart here is basically the NASDAQ, the S&P, and home prices priced in first USD. So, since COVID, you think you're doing great. Nominal terms, you're, up 165% in the NASDAQ, your house is up 56%. But if you price that in gold, the NASDAQ is barely above water, 7%. The S&P is actually down. Your home is down 37%. And if you price in Bitcoin since COVID, you're materially down. Your house is down 87%. The S&P is down 84%. So this is what you're talking about, Michael, of the recognition of nominal versus real. But in practice, what that means is it means swapping out the denominator for something real, as opposed to something nominal, which is the dollars.
This is something that we, as on-ramp, but then just as Bitcoin investors, should promote a lot more in different ways of just using different denominators. Like I've just started to read the book End Times that Groman recommended, so by Peter Turchin. And so we've all heard similar statistics like this before if we're into these esoteric topics, but Turchin was highlighting that in 1971, the median wage worker, it took them 150 hours to be able to afford higher education. And then I think the second signpost, the year was like 2010 or roughly in the early 2000s, that took 500 hours for that same median wage worker to achieve university. So it's all the things that we feel, and you can apply those to home prices or any kind of American dream type goal, but they're important to highlight and help people change their frame, because we're all being gaslit all the time too. Because then if you look at like the Wall Street Journal, the article will be something to the effect, and they have these all the time, of like, millennials are richer than ever, but they just can't appreciate it, and they're so depressed. Like look at their wages are up, and all these wonderful things. So I think when you look at like pricing in gold, that can make sense to people. Pricing in Bitcoin is really going to be a stretch because it's such a weird, new, nascent asset on its own. But whether it's like median hours or other ways to highlight some sort of inputs and outputs, that is going to help people to pull out of that dollar phenomenon, especially as we go into a melt up type period. And then going back to what Paul Tudor Jones was saying, do you guys, when he mentioned as the NASDAQ is the last part of that bucket, is he betting on like an end of year melt up as part of that trade?
Yeah, absolutely. I mean, I think that's part of his thinking is it sort of gets back to like where else does the capital go? In the sense that this sort of, I mean, really the stock market has been driven primarily by AI related stocks, so Nvidia and some others over the past year or two. Really since ChatGPT launched, I think there was some wild data that like 75% of S&P returns are driven by AI related stocks since then. So it's kind of, the way he articulated it in that interview was kind of like, music's on, so you got to keep dancing. The administration has been pretty clear, like they're just going to run it hot. They're going to grow our way out of this debt, which really means just, debase people. And so you better own hard assets, and, quality equities, while not as hard of an asset as gold or Bitcoin, or even some areas of real estate, it's all a relative game, right? Like, so if that is the trade for, because most people are still in a 60-40. So there's a lot of capital and wealth tied up in the S&P and the NASDAQ. And so if all of this stuff is just going to melt up, we're going to run it hot. The money's going to, be exponentially debased. The NASDAQ's probably going to do pretty well, at least for a time. Maybe there's some bumps along the road when, maybe the productivity miracle doesn't materialize and people realize that all of this spend and capital deployment towards all of these AI related ventures, a lot of that capital is going to be destroyed, is probably a wake up moment for at least equity markets at some point in the future. But yeah, I think that is what he's saying, is like, all of this stuff is going to melt up as we just print more money, lower rates, et cetera.
Yeah, people forgot that at the beginning of the year, there was Doge and Trump was going to, balance the budget by the end of the year. And that was right before everybody pretty much recognized, whether it's the debasement trade or hard money renaissance, that there's just going to be more monetary units that come into the system. It's going to be, whether it's here in the US, a new Japanese prime minister who wants continually low rates. Like there's not going to be much that's going to catalyze a real shift in sentiment or the trade to shift.
All right, quick break. If you're enjoying the episode, please leave us a like, a comment, rate 5 stars, subscribe, depending on where you're listening. If you are on YouTube, a comment really helps. You could leave positive feedback on the show. You could leave constructive criticism. Any of that helps. So please, if you can, just engage, take a few seconds, like, subscribe, comment. It helps a bunch. We spend a lot of time to record, edit, distribute the podcast. So thank you very much in advance for doing so. I really appreciate it. Now on with the show.
I think there's one critical thing we can't leave out, because we understand that there's a debasement. We understand there's been debasement. This trade is being put on. There's gold and Bitcoin that are fundamentally different. The problem still exists. That's a gap. And that most people, even if they want to get there, they don't feel confident in how do they get their exposure. Because for 15 years, you've known not to trust a single custodian. And so even if you absolutely love Coinbase and BlackRock, are you really willing to park material capital there? And that's why most individuals are still severely underallocated to Bitcoin. And then the other side of it is ultimately leaving it on a ledger. We'll probably go into this later about IBIT's performance, but we were talking about it on a different podcast today about IBIT having $100 billion or close to it in inflows. Maybe it's already surpassed that today. Probably not, given the retrace. But point being, is a testament to how screwed up self-custody is for the majority of the market, because that inflow happened in 400 days. And that wasn't, there's institutions coming in, but there's a lot of retail investors that have historically wanted exposure and they just want to click a button. But we also know that that's not the best exposure for a number of reasons. And so that's really where the focus has come on from here, whether it's collaborative custody that me and Cam were building previously to this business, that inherently even collaborative custody has this scalability limit because you're putting the onus on the individual, and the individual not only has to manage private keys, but like the seed phrases. They have problems if they're traveling, if they're not traveling, if they have a config file, where do they park it? How do they make sure that they have the code right? Do they have a backup to do? There's just a whole slew. And as the price keeps ticking up, those problems become more and more acute. And then you have to think about bad actors, and you have to think about dynasty trusts. everything under the sun naturally has these limitations. And again, we've played this out before. Like all these concepts are timeless in the sense that sound money is how the world was, created to this point, in the same way that the reason why people ended up with goldsmiths and then banks was because enough people showed up at their house to kill their family for their money that they ultimately said, hey, I need to trust it with a safeguardian. Obviously, that failed with gold because of the centralization problems, but that's the beauty of Bitcoin. It has this ability to insert governance at the protocol layer. So I think that's just a huge component is you need the market structure to catch up. And so it's not really, even if you're listening to this, and most people probably at best, even on this pot, listening to this, are 2 to 10% allocated. I would make the case, not financial advice, but it's severely, maybe it is financial advice, I don't know. But, or severely underallocated, but it's not your fault. It's because you haven't actually had the right product, services, separately managed, wallet, on chain, insured, everything that we do and will continue to do. So it's the best time to buy Bitcoin, as everyone says, was yesterday, and then the next best time is today. So don't hold yourself short if you didn't really get to this. And it's the same thing with gold. Gold's a great trade, but then you still have to figure out what are you going to do with it. And nobody would ever say park 100% of your wealth in gold and then put it underneath your mattress or your land. But for some reason, again, those local influencers that a lot of people listen to on the podcast channel will say, yeah, like just figure it out. It's not that hard. Put all your money on the 12 words and the seed phrase or the 12 words in the hardware device, and go about your life. And it just doesn't work like that. That's not how society's going to adopt Bitcoin. And it's not because I want it to not happen that way. It's just because $100 billion has flown into IBIT, because that's not how they're going to do it.
Yeah, 100%. That's well said. And it's also it becomes more or less speculative when you actually figure out and are comfortable with your custody setup, and everybody's happy to take a NASDAQ flyer on IBIT accounts in their retirement or just in their Fidelity account, having the Fidelity ETF or whatever it may be, just because it's super easy and simple. But obviously we know that's an improper product as people get out of that and try to, hold, and they're going to want actual Bitcoin.
So I have a quick little quip. So Cam, hopefully I don't dox him too bad. I'll just do it. So Cam and I have worked together for 5+ years. He came down to Texas and helped early stages with me build out Unchained, and came over to OnRamp, and we've been growing this business like crazy. But it was still looked at like a lot of people listening, and maybe us within our family circles, of like, are you nuts? Like, you're going into this new niche industry. It's speculative, all the things that we know. And I found this tweet that I think is a picture of Cam at the dinner table. It's basically, is this how the conversation's going, or how's the conversation going right now with the family?
I've got a positive article the other day from a close relative, and the ratio of the positive to negative articles is typically 10-1 at best, maybe worse. So I showed my wife, look at this, here we go, we got a positive one. But there have been plenty of Joe Pesci stares over the years.
Yeah, it turns out we might be right, guys. We might be onto something here. Just maybe. I did want to highlight, as it relates to the ETFs and these custody issues that you've articulated, Michael. It's both sides of the spectrum, right? Like the obvious issues that you just outlined with self-custody, but then if you're just piling into the ETF, you have an issue as well, because most of the ETFs, I've been included, are custodied at Coinbase. And so this is a tweet from Sandy, who put together timechainindex.com. It says Coinbase Bitcoin under management surpassed 2.9 billion or million BTC after receiving around 800,000 BTC from Deribit following the acquisition by Coinbase. The honeypot is getting bigger and bigger. And so this is what's in the back of people's minds, either consciously or subconsciously in some instances, of kind of what you described, Michael. Of it limits people's exposure, because if they have enough of an understanding of Bitcoin to recognize this is a digital bearer asset, if I have a single point of failure, it could go up in smoke. It could end up in the UK landfill or in the hands of North Korean hackers. This is what limits people, because you don't have assurances, real ownership assurances into the future that the Bitcoin that you are entrusting to a custodian or perhaps a group of custodians is actually yours. It's legally titled to you. You have on-chain transparency to see the coins there. That's not the case with any of these ETFs. It's omnibus structure, single point of failure, single custodian at Coinbase. So just thought this was worth highlighting in terms of the context around both ends of the spectrum have issues.
Yeah, this is go ahead.
I just shared over an article. So the barbell approach for custody that we recommend, or that a lot of us use, or our clients use just kind of naturally, is still using self-custody for some amount of funds, typically a minority. It's up to everyone to decide, but then using multi-institution for most or all of BTC. And everyone will get to that point eventually where it's like a less than 1% or 1% allocation in a Trezor, and 99+% is an MIC, but we'll help you along that journey. So, I do the same thing for content. I'm on X, but then I'm also on the Wall Street Journal just to try to balance out some of the insane things I read on X. But it's interesting when you read something like this from Wall Street Journal a few days ago. The best way to invest in Bitcoin without actually buying cryptocurrency, which just like kills me. It's like that's the last thing that this industry wants, right? Is just to have a complete paper market, multiple layers of counterparty risk. And Bitcoin is like a caged lion that's just controlled and never sees the light of day, really. And that's really the future that we're heading toward if we're telling everybody you all have to self-custody, because not only just newer investors, but plenty of long-time investors will hit a breaking point and say, I'm just going to go in the ETFs. I can borrow against them. It's easier. It's low fee. So this article was focused on, which trusts or ETFs or other funds track the net asset value the most closely. But the first sentence in there is, scroll down, Brian. Many investors want to hold the cryptocurrencies, Bitcoin or Ether, without the hassle of holding the cryptocurrency, which can be lost or stolen. So like that truly is on the top of everyone's mind, that even if you really do get excited and curious and develop a thesis around this asset class, you have to worry about this whole other aspect of it being stolen. So go into something like the ETF.
The beauty is one of the big components was getting multi-institution out into the market, and we know individuals, we see it day in and day out. We end up working with some of the most sophisticated investors from some of the largest firms that have custody solutions, because ultimately they recognize like this is a better way. That's the important 0 to 1 moment, in the sense that I don't fear of this happening long term, simply because just like Bitcoin will win based on its own volition and properties, multi-institution on a long enough time horizon will, because very astute, prudent investors, once they get material balances in these constructs, will ultimately understand about the risks. And the risk will come from their own diligence, or they'll just naturally happen as the market grows, that it doesn't happen in a vacuum. And as more liquidity comes in, more risk comes in, and there'll naturally be more deleveraging and losses. So it's less around, it's a good thing to be concerned and think about centralization, but it's more about like your assets, where some people either don't feel they're, Bitcoin being an asymmetric trade. If you're not in Bitcoin, you're losing purchasing power. Or if it appreciates and you get worried about concentration risk, you're reducing it, or you're putting yourself in a position for your family to be kidnapped, hacked, house fires, not sleeping well at night. So we haven't actually publicly announced this, but just for folks listening, that we are going to be rolling out, we've gotten to a certain scale where we can actually increase our purchasing power with custodians to lower our costs. And that's probably been our biggest thing, because a lot of people listening are like, okay, we get it all the time. You guys are the Rolls Royce of custody, but I'm not ready yet because I don't have X, Y, and Z stack, or I'm just not ready to, participate because of the fee structure. We won't share it here, but if you reach out, we'll have some exciting things that we're going to formally announce either later this year or early next that will make this a lot more achievable. Because at the end of the day, if the rest of the world is still severely underallocated to Bitcoin, then it's our job to continue to reduce that cost, to make it more appealing to them, for them to get a better custody solution, and then along with the financial services we offer. So a lot more coming from what we're doing there.
Yep. Great plug there. More to come. Can we go back to Japan? Liam, you had brought this link because I think it's just to sort of frame the segue. Like, we're talking about this debasement trade, but what are the ripple effects effectively, really at the sovereign level, as people wake up to, effectively this administration wanting to, quote unquote, run it hot, debase the currency, And what are the knock-on effects sort of at the sovereign level in terms of what we're seeing there in Japan? Let's start there.
No, I was just gonna say, they're gonna run it hot too. They have inflation that's above target. They're have had negative yielding bonds for a very long time, and their new PM has the same exact economic philosophy, and they have massive amounts of debt to GDP. I think it's something like 270%, and so they're going to want to continue to have artificially low interest rates in order to grow their way out of the massive amount of debt that they have. It's Japan is, just going to be another one of these countries who doesn't want to really face the problems. I mean, I don't envy any of these politicians who has to, come in and be the bad guy. And so I don't think that, any of them have any real incentive to at this point. It's going to be, to segue into one other thing that's going to be interesting too, is I think it's just going to be a matter of competitive forces that end up causing governments to, actually show some austerity and keep, interest rates at the rate that they actually should be in the market demands, just because there's going to be more and more competition for stable coins, especially those, that enter into other markets too, and they're going to be able to pass yield to investors too. So if investors in Japan or just everyday normal people are insufficient and unhappy with the amount of debt in dollars that are going, or yen, whatever currency they have over there, that are going into their system, they're going to have the ability to opt out to dollars. And at the whole time, gold and Bitcoin are going to be there as well. Those are going to be a little bit more of a leap, especially Bitcoin early on, but we're going to be going into a world in which people know that, all across the world, the debasement trade is on until further notice, and they're going to be looking for better options in order to store their capital.
Yeah. And there was another link that I'm pulling up now. Michael, I think you brought this one somewhat related to what Liam was just walking through in terms of sovereign reactions to this. So I think India has been an interesting one, sort of historically, in terms of their stance on Bitcoin specifically. But I think just last week, when you first added this to the list, Michael, I actually thought it was the headline I saw last week, which was that similar to what we've seen in China over the past several months and years. India has been stacking gold, so there's been a spike in inventories of gold in India. So playing into the debasement trade as well. But what is this article specifically talking about with respect to CBDCs?
Yeah, I mean, I think like India historically has kind of been on the wrong side of history when it comes to reserve assets. I believe India and China were the last to go to the gold standard, and they kind of paid the price. I think that there's like a 2D version of how to play what's happening if you're a sovereign. There's a 3D version. I think the US is playing a 3D version, meaning like they have plans for Bitcoin that go back to what Cam was alluding to, and corralling it and creating constructs. But they're at least bringing the assets on shore. Well, this looks like a 2D version, which is like, hey, we're freaked out about this. We don't want capital flight. And so they're doubling down on the negative stance on crypto and Bitcoin. And then it looks like they're also heavily investing in kind of like CBDCs. So, India's been historically antagonistic to Bitcoin. It sounds like they're continuing to. But I think we're going to see these different versions. There's a 2D, 3D, and maybe there's an additional dimension that some sovereigns will recognize. Hey, let's just let this thing freely roam, and that'll bring on economic prosperity. But that's a maybe wishful thinking, because it's a lot to give up control of the sovereign currency.
Yeah. And then I also found this interesting related Tether, which, I think frankly, just based on their holdings of reserve assets alone, so, Bitcoin, gold, all the treasuries they own, I think they own land as well. They're effectively sort of a quasi sovereign themselves, like a digital nation state of sorts that has all of these massive reserve holdings. And this came out the other day that They bought 19 tons of gold in Q2 alone, which is about what China's central bank bought over the same period. And so we don't have Q3 numbers yet. But I thought this was pretty stunning. Like Tether it's basically its own nation state acquiring gold.
Yeah, Tether's easily like just one of the most sophisticated entities on the planet Earth, and it's just indicated by its portfolio. Like the thing that's existed for thousands of years, they've been, rotating into between land, gold, BTC. So just consider that one like sound hard assets, and then their business that generates an insane amount of Bitcoin, gold, or cash flow, however you want to refer to it. So yeah, it's just astonishing to see how long they've been playing the gold trade. And it came out today, I think, for the first time, tokenized gold surpassed $3 billion. And again, not saying it's good or bad. It just is that the market, it's the same thing that's probably going to get pushback, maybe here, but also just externally around. Gold is going to run. It's going to run for a long time. It's going to go past $10,000 an ounce. And then naturally, people are going to want to leverage it in a way that looks like Bitcoin because it has properties that make it mobile. And so you're going to see the tokenization of gold. You're going to see these trading pools that happen. And it's going to be TBD on what that looks like because naturally you're going to have counterparties that, get completely rug you or they get rugged. Sovereigns may start to close their borders on what bullion reserve is being deposited. Maybe it gets lent out. There's a lot of things we're going to have to learn through it, but it will be coming because, again, it's a much easier leap to understand tokenized gold versus I'm going to park all my money in magic internet beans.
Did you see that Tether is partnering with another company, Entalpha, to raise $200 million for a DAT strategy with their gold token as the core asset?
I didn't, but I think I said this in a private chat. And I've been thinking about this for a few weeks. Like we're going to start to see as gold and silver go. And I think somebody already kind of is doing this, but we're going to see the DAT strategy around gold, which is already kind of exists with gold miners because gold miners historically have gotten a monetary premium on their equity value outside of the underlying because they're effectively being able, they have like an actual business that pulls gold out of the ground. It's similar to Bitcoin miners, right? They're seeing a nice uptick. So I think if you're producing some kind of like cash flow and revenue, it's not really a DAT strategy. I'm not saying that's what they're doing, but we've talked about this forever. Like businesses that just produce value and then park their money in a harder form of money should naturally get a premium because they're just going to outcompete the other businesses. But that's completely different than the other thing. I don't know which one they're doing.
Yeah. Other side of the coin, no pun intended, of acquiring sound money for your nation state is Germany, who, if you remember, about a year ago sold 50,000 Bitcoin at a price of around, I want to say like 56K. So not looking too hot on that. And then, they are announcing, or I think there's a working group within sort of related to the German government that has proposed raising the retirement age to 73 to prevent the collapse of the pension system. And so this is pretty startling, just in the sense that, I think just the fact that they are now saying this should be of concern to you, because I think the reality on the ground is that pensions have been cooked for probably over a decade. And, it probably would have helped if they had held onto that Bitcoin or even bought more. But any takes on this? It's sort of a sad state of affairs, but this is, not an isolated incident to Germany by any means. Pretty much all pension systems are underwater and cooked.
I just don't know how they get out of it. I don't think that there's a great answer either way. I think the older generations are the most motivated to vote, and they have all the capital and political power too. And so nobody that's 18, 19, 20, or even 30 is going to be paying the lobbyists anything. And that's how Germany, or I'm assuming this is how Germany works too, just because it's how the U.S. works. And so I don't think this is actually going to happen, just because they're not going to cook all of their tax paying and lobbying citizens. But I don't see a solution either way.
This is how you get your friends and family, by the way, in the sense of like, we talked about this a little bit, but this pod's going to come out before, and the point is still pressing because there'll be overlap of like, it's a moral imperative to discuss these things across the board because ultimately everyone's purchasing power is being reduced. So even if they didn't raise this, anybody that's getting Social Security or thinking about retirement, whatever that stipend is going to buy them less and less year over year, even for what they initially planned. And this is like a back-ended way on how I kind of got my mother-in-law to like spike coin into Bitcoin because she retired. And it was basically sitting around one day and I was like, look, you may be fine, but whatever you thought how far this was going to go or what you're going to leave your kids, or ultimately, because you start to feel it, right? Like you pay for family vacations and you look at it and you see year over year, you're like, well, this is like increasing. And my, like, my retirement with my financial advisor has me in, bonds, doing whatever they're doing. It just, that really gets to people is like, oh shit, because it becomes very visceral to understand that like everything I ever worked for is effectively up for grabs now. The world is inherently more volatile. And so the point or the net, if you take anything from any of this, is like share any info, even from the local podcasters. I may not know much. It's still better than anything. Or this podcast, refer them over. Cam will take handhold them. We will all handhold them. But it's just really important because there's not many solutions. And what Liam was saying earlier, they're going to obfuscate a lot of this stuff from the debasement trade by offering like some nominal yield on top of other things to say like, oh, you can outpace inflation by trying to get it, but it just doesn't work. The math doesn't add up. And this exists for everyone on the planet Earth when it comes to how do you like protect your future if you're just stuck in the system where they can continue to create more dollars.
We recently launched On-Ramp Guardian. This is a feature designed to protect you and your Bitcoin against physical and digital threats. This is included on all On-Ramp accounts. And so if you are thinking about social engineering attacks, $5 wrench attacks, people accessing your account through credentials, 2FA, etc., if you're just generally concerned about the security of your Bitcoin long-term, whether it is a digital risk, a physical risk, or it's both, get in touch. Like I said, this is included in all On-Ramp accounts, On-Ramp Guardian. And there are a lot of different ways that this can protect you against the increasing sophisticated attacks that we are seeing every single day. So get in touch with us, onrampbitcoin.com, book a consultation if you're interested, and I would be happy to share more about what On-Ramp Guardian means for you. Thank you.
Yeah. That is the other scary part, is that this is multifaceted, right? Like this raising the retirement age, that's one of many aspects of life that will become more and more difficult. Like, so back in Minnesota now, in the metro area, a lot of cities and counties are proposing 10% increases on property taxes for 2026. Like, so if you're on fixed income, you're retired, you're receiving your Social Security, that is not only worth less as it's being debased, but every cost of good, every aspect of your living is increasing. So yeah, whether it's gold or Bitcoin, we need to get this out there that these are your life rafts.
Yes. It's well said. Where do you guys want to go from here? You want to talk a little IBIT? Michael, I could pull up your tweet from the other day. Now, we just sort of, we've razzed on ETFs a bit. As you may be accustomed with, our solution, we think there's a better way to own the asset. But that being said, IBIT has been the most successful product launch of all time in financial markets, full stop. Nearing 100 billion in assets, set to smash the previously set record of a little over 2,000 days for VOO. IBIT's going to do it in 435. Even more staggering, IBIT is now BlackRock's most profitable ETF by a good margin. It's also in the top 20 ETFs by assets just globally. And this is all against a backdrop of very early innings in terms of actual access and ability for folks to get exposure to these things. Now, we know certain banks, wirehouses, sort of incumbent firms have opened up access to these things, but there's a number who still haven't. And even the ones who have approved it on the platform, there's often restrictions in place in terms of can advisors actually solicit clients on getting Bitcoin exposure. We're still very early days in that respect. So that's the exciting thing about all this to me is it's nice that these products are a solid, easy button for folks to get off zero in terms of at least price exposure. But we really, I don't think, have seen the full breadth of what these products are going to do over the coming years. Because again, the access is still, the access and the plumbing and the solicitation is still not, anywhere where near where it will be in, another 12 months or so.
Yeah, we don't have to go hard on the custody setup. I think maybe the one big takeaway I think about this is we're so early in all of this that like the exposure to IBIT reminds me of the best analogy, and it's not apples to apples, is if you thought this was the end game, it'd be like if you were using a computer or the internet to send an email and you thought that that was all you're gonna be able to do. Like there was a lot of value in being able to send digital communication, but it was severely understated or didn't have the foresight to know how influential or how much value this would bring. And again, I think we just naturally look at things in either a two-dimensional way or in a vacuum, but the price appreciation doesn't happen that way. And what that means is as more people adopt and buy this thing, then more people start to recognize its value, and then more people will want to, as an easy example, accept it. You can't use it for anything if it's stuck there. And it's still tied into the existing traditional system that has, when we've discussed and everyone understands if they're playing this trade, that the system's fragile. There's a counterparty risk everywhere. There's going to be insolvencies, and you don't want to be mixed up in that, along with all these other issues. And so I think that's the core angle here. And I don't think it actually matters how much education that happens there. The market's going to get educated because as the price appreciates, the market will naturally sort itself out of liquidity and risk coming in, and then people will start to question their underlying counterparty issues. Again, why I speak so confidently about this is back to Cam and my experience, like 21 and 22, you told the stories in 21 about BlockFi and the nominal cost that was more expensive in nominal terms, but in risk-adjusted terms, it was much cheaper to park it in a decentralized way with no rehypothecation and over-collateralized. It's very similar here that it may even seem, and I don't even think it's cheaper than what we do, but the point still remains that it may, even if you just hold it in self-custody, like nominally it may be cheaper, but risk-adjusted, the amount of risk you're exposing yourself to on a long enough time horizon is undue, and that will just happen as the price appreciates. Everyone will just realize this.
Yeah, that's a big disconnect for folks when they think about custody and they think about the costs of it. If you're holding coins on Coinbase, you think you're paying nothing for custody effectively, but you're really you are paying something in effect for that tail risk of having a zero at some point into the future. And because of that, there's sort of been this subsidy for custody, generally speaking, in digital assets, where you think you're paying nothing, but you're actually on a risk-adjusted basis paying something in terms of your actual allocation potentially going to zero. And it's the same idea with self-custody. If you yourself are the single point of failure, that is the tail risk that you need to be assigning some amount of value to. And if you can wrap your mind around there being some value to protecting against that tail risk, then the costs of superior and more robust fault-tolerant custody start to make a lot of sense.
Yeah, I would say it's even greater. Like there's that part, but there's the one that's probably even more prevalent, and it's crazy when we talk with clients when we catch up, is the peace of mind, because what you're really paying for it is worrying about this underlying asset. It's really kind of crazy. We got to $2 trillion with nobody really knowing if the next day their house burns down, they mess up, they get hit by a bus, their family can't get it, or the third-party exchange, for whatever reason, just doesn't give them their Bitcoin because of something they tweeted. The point being is that peace of mind disruption costs a lot and will only increase. So anyway, Cam, sorry.
No, I just had a vivid memory of you and I being back in the Unchained offices. I can't remember if it was a team meeting or something, or we're kind of walking out of that main office boardroom. And you're like, guys, how are we going to hold Bitcoin when it's $500,000? And we just, it's just kind of like classic Michael style, just a little bit abrasive and just to the nose, but so truthful. And I think there's kind of a general sense or a different mix of like, well, just like we are now, like you do your key checks, you've got your keys in cold storage. But the bigger point there was there's cognitive dissonance that exists because we're all convinced that Bitcoin almost assuredly is going to go to $500,000, $5 million, maybe much more than that within our lifetimes, very probably. But then practically that feels so much different. It's hard to understand the ramifications of that until you're there. So that really is that lack of peace of mind. Like functionally, you could still do your key checks and replace the devices when they break, and check your seed phrases and your wallet configuration files, and test your backups, and review your inheritance plan if you have one with your loved ones. But in all the time in between, mentally, all those tail risks are not, now there were tail risks, now they're much more probable, and now they're consuming more of someone's mental energy. So it is a totally different exercise, but just there's something about human nature where it's so hard for us to appreciate that before we're there, which is why I saw NVK tweeting recently the classic trope of protect your Bitcoin like it's worth 10x. That's still some of the best advice out there.
Yeah, my favorite mental model is like, all right, let's go to, we're all holding our keys. Like, now what? Let's pretend like from a UTXO perspective, everyone can hold their keys, which is impossible. And then from a socioeconomic perspective, like let's say we all want to be our own bank, which I would say is more impossible because at least technology you can manipulate from a UTXO perspective from humans. Humans are humans. But let's say we got past that and everyone wants to be their own bank. Our grandmas and every individual is just sitting with a ledger, up a personal crevice or hidden somewhere in a personal crevice in their house. Now what? Like, play that world out from how do you coordinate economic activity if we want to like flourish as a society? How do you actually manage, your house not getting completely ransacked? And if you have a big citadel, well, then how do you know that the next neighboring citadel doesn't come for your underlying? Like, there's 100 reasons where that just naturally doesn't play out in the same reason gold didn't. But to your point, it's just like, we're very early stages in this industry. And so, and it also, it's not to be said, like the first 15 years, self-custody really was the only option because you couldn't leave it on a third-party exchange. And even today, as long as you're not 95 years old, I would still say if you had to pick, it's 100 out of 100 times you want to self-custody over leave it on Coinbase or BlackRock, because at least the control or messing it up is up to you and your situation versus a third party, just you waking up the next day. We're going to increasingly see that. But again, there's no perfect trade-offs. There's just perfect solutions. Or I'm sorry, there's no perfect solutions, just, perfect trade-offs for you, and everyone has their own individual preference. But the world ends up in a Pareto distributed fashion, and ultimately we think of what we're building here. And the beauty is it scales proportionally to the amount of assets. So I've talked to the SEC commissioners about this, that over long enough time horizon, I fully expect multi-institution to proliferate on the public treasury side. We're onboarding some of the biggest ones, as well as for the ETFs. It's just a consumer protection thing when you have 5 different custodians and you have a 405, 305, whatever it is, protecting, $1 trillion plus in assets. We're just so early that we're going to have to see some carnage in the system before the market recognizes, oh, wait, the thing that makes Bitcoin different than gold is that there's governance that can be inserted at the protocol layer.
Yeah. And that learning specifically, I would characterize it almost as like unlearning the historical trust in financial systems and in institutions generally. Like that, I think, is the success of IBIT and the ETFs, I think, is indicative of, largely to an extent, the fiat mindset of trusting institutions and thinking that everything's going to be okay because the big boys are here now. And they've got everything figured out. When in reality, like BlackRock just outsourced it to Coinbase, which should raise some red flags in your mind. But yeah, that was all well said, Mike.
Brian, can you put up the Fortune article? Because I think that's pretty interesting for a number of reasons about the central banks. So this is funny because this report came up like 2 weeks ago from Deutsche Bank around that Bitcoin and gold end up as reserve assets for sovereigns. But Fortune picked it up a week later and says central banks will end up holding Bitcoin in their reserves, even though it's backed by nothing, Deutsche Bank predicts. And I thought this was interesting for a number of reasons. One of the big ones is less around the headline, which we can, make fun of them for that if we want here. But I think it's the notion that it's this idea that super cycle is not a good word, but we got to come up with a better one of like, we're just in a secular change, right? Like this sound money renaissance, like the notion that this isn't what Bitcoin, I think we can probably safely say, has moved from pure risk on, and it still sits as a risk on, but it also has been playing for a lot of people risk off. Will increasingly, with the debasement trade becoming understood, will be more and more risk off, specifically for sovereigns. And if that's true, that completely changes the market structure for how long this goes, how high we go, and ultimately how low or how high we retrace. And so I think this is probably worth talking about, because this is the thing, and it's hanging over our head with the whole US SBR thing that I still think is very much in play that nobody's talking about.
Yeah, well, Christine Lagarde also was asked this week about Bitcoin again, and she once again said it's backed by nothing. It has no intrinsic value, despite it being only, I think, maybe 5 or so years younger than the euro, which, was also created just by a bunch of people sitting in a room and doesn't have any, thing securing it. There's only one node for the European Central Bank, and so ultimately it's just a time game too, with all these people, and getting them more educated. I think that many central bankers likely understand that this is, or at least some people within the large central banks understand that this is a reserve asset, or some likely still think of it as a risk on trade, and so they're not going to put anything that they inherently think is a risk on in their central bank reserves. But it naturally will have a few people advocating for Bitcoin within pretty much all of these central banks over time, just as time proliferates.
Quick question for the group, like, let's, because you can make the case, like, gold's backed by nothing, right? Like, it's like, what's the fundamental value or whatever? If they didn't have this to say about Bitcoin, there would be something else that would step in. Because let's say there was physical Bitcoins that existed, that they could say they're at, like, what would be, there's something else that would be the prominent thing. I can't think of it. I'm just curious, because that's effectively where we're at this point, is it's just cope of like, it's backed by nothing because I can't touch it. And then everyone listens and says that same talking point, and then they just go about their day.
I think it would move to something along the lines of like, it's too concentrated so that we're going to end up in the same place as fiat, theoretically. Now, I don't believe that to be the case. I think there's a natural distribution that's occurring over the past 16 years that will continue. But I think that would be a line of thinking of, well, we still can't support Bitcoin because it's just going to enrich this group of insiders that were earlier than us to the thing. And that might happen anyway at some point, in terms of, the spite and the anger towards Bitcoiners accelerating into the future as the price appreciates. And for those who opt to stay on zero, I think that'll be part of their coping mechanism to say, well, we can never transition to that system because it's also unfair to us because we don't own any. Like that would be, I think, maybe the track they would take.
Anybody else have ideas? I don't have any. I was thinking about it.
And so, like you say, like if Bitcoin didn't exist, and outside of gold, like what other asset would people be fleeing to in this debasement trade? Or
no, it's more of like, if there was, because they're saying it's not backed by anything, like that. There's no generally when people say it's not backed by anything, there's no physical manifestation in the real world. So it's like, well, what backs it? What is it? And so I'm saying, like, if let's just say there was physical Bitcoin, like what would be the FUD? You can make the case that illicit activity, centralization, like Brian was sharing, but there's some other angle that I just thought it's not important. It's just more of, it was just a thought experiment, because there would be another reason. Ultimately, they wouldn't come to the conclusion that it could be a store of value just because it had a physical construct.
Yeah, I mean, it's not created by the government. Like it's illegitimate for that reason, because so much. We've been 100 years of that view. Like, how could a money be emergent, but and non-government, but also legitimate?
Yeah, it's I think we're past the Satoshi can come back and create additional Bitcoins too. But I guess not if she still thinks it's backed by nothing. Yeah, so it'll be the centralization, and everybody says like, oh well, it's outside money not controlled by the government, but BlackRock holds a bunch, as if like other people can't still hold it too.
Yeah, that was an interesting part that I'm sure, Brian, you felt when we had Jeff Booth on, because there's a notion that like Bitcoin is just this like panacea for everything, and the reality is like there's like humanity's like exists in a fractal of like increasingly decentralization from like power, but it ultimately still is very much centralized. It's more centralized than we'd like to admit in the existing construct. And even if Bitcoin proliferates as a store of value, is still going to have a notion of centralization. It's just less in that fractal. And then there's the component that you referred to of everyone still has access to a money that can be debased. And it's not completely apples to apples, but it's close enough to like gold and where gold was for thousands of years. Now more people have access to it. But I think like Jeff will posit that it's a completely new paradigm and it's a positive sum game for everyone. And I think there's some notion to that, but it's still closer to gold than it is to like this completely new thing, that like way of thinking. Anyway,
Yeah, and
that's
I've
just
heard so many times that there's not enough space on the chain in order to process as many transactions as Visa and MasterCard, not with any understanding that there will be additional L2s and they can have off-chain credit and settlement as well.
Maybe last thing before we go, I don't know if Brian, you had something, but this one, I had missed this. I don't know if you saw it. It was a few days ago where it says the story is simple. Trump said America can grow its way out of debt. What it really means is debasement. Shutdowns highlight the erosion of trust in U.S. institutions. Bitcoin is the pressure valve. That's not bearish S&P. That's bearish the dollar. This is from Goldman Sachs.
Yeah, I mean that's a perfect summary of really the entire discussion. That puts it quite succinctly, and it's from Goldman. So the only other thing I had was we are recording this a little early in the week because we're traveling. The group of us will be in Dallas the next few days for TexCap and the North American Blockchain Summit conferences in Dallas. So if you're in Dallas, reach out to any one of us if you'd like to meet in person and chat. We'll be also hosting a happy hour on Thursday, so check our Twitter feed for info on that if you'd like to be involved. The only other thing I was going to say, because it's earlier in the week, can I get some end of week price predictions so that people in the comments can make fun of us on Friday?
Well, we're sitting at $120,000. So
yeah, we're at like 120. Yeah, a little under 121 right now.
The real question is, do we like ninja launch this tomorrow and miss Jackson's Friday deadline? Jackson likes to run a tight ship and have it consistent, but I
don't know. I've gone back and forth on it, to be honest. Like I do like the consistency of Friday morning TLTs, but
I do have an idea for Friday. So, well, we can talk about that offline.
Okay.
We'll make the call, but I say we were teetering around between 123 and 125 at the end of the week.
I'll take the over. I think we're going to be at a little under 130 by the end of the week.
What was that? 250? What did you say?
No, that's next week.
No, but if we do ninja launch this, reach out because Cam has very big plans for nights out in Dallas, and so if you'd like to participate and join and hear what we talk about after having a few drinks, you definitely want to reach out and we'll get you. I've seen the work Cam's done on peers. The next morning, you're walking in and seeing certain individuals that won't name. So just be very careful if Cam's out and wants to buy you a drink. He's really looking for a mark because there's only so many days he gets to travel for business, and he likes to take advantage of them.
Very well.
So much innuendo there. If you come out and hang with me, it'll feel like 150K Bitcoin plus easily. So it doesn't even matter what the price is or price prediction, but you got to work hard and play hard.
You'll feel like $1 million Bitcoin the next day.
No,
right,
you'll feel like E. You'll feel like E.
Wait. One great tweet from Kobe today.
I knew that was going to come.
I got it. I mean, it was just a great tweet. He was like, what if, something to the effect of, what if gold reaches 5K before ETH? Just hilarious. Also very possible. We'll see. All right, boys. I think that's a good rip for today. Thanks for joining me.
In the comments, let us know if you like the pod with or without Jackson, because we can always make changes. We're a very flexible unit at OnRamp. We like to be iterative. That's how we move so fast. So if this is a new format that you guys like, let us know. But if you also love to see Jackson's
if you miss Jackson, sound off in the comments.
Let us know as well.
All right. Thanks, guys. Thanks for listening to this week's episode of the show. If you found the information valuable, please share the episode with a friend or leave a rating on your favorite podcast app. All the links we discussed in today's show will be in the show notes inside your podcast app. Before we finish, a quick reminder that OnRamp Media is for informational and entertainment purposes only, and nothing should be construed as investment or legal advice. Regardless of where you are on your Bitcoin journey, we'd love to hear from you. Visit onrampbitcoin.com/contact to schedule a consultation with one of our private client advisors.